Hello, I'm Eric O from Eric Wealth Advisory, where I have my Conviction Compass, where we share valuable insights from listed companies in Singapore as well as top leaderships. So today I'm very privileged to have Simon here to share about his recent earnings as well as developments in Stoneweg.
Eric, thank you very much for the opportunity to catch up. Stoneweg European Stapled Trust has 104 assets, predominantly logistics and light industrial, throughout 10 countries in Europe. One of our advantages is that we're predominantly freehold and over 1,000 leases with indexation clauses. So we are able to generate net property income growth. The second major USP of the REIT is we have 300 Stoneweg staff on the ground in each country, speaking local languages and being involved in local communities. And this really helps with things like tenant retention, on expansions, on AEIs, and that also has come through in our recent results with 4.9% like-for-like NPI growth, as well as coming through on the valuation side of things with the third half in a row of our valuations going up. And that's driven our NAV up 7 cents to 2.05 euro cents. So where we trade today on the SGX is at an 8.3% yield and around a 20% discount to our new higher NAV.
That's great news. Okay, the second question I think that's pertaining to the investor's mind will be, what's the value of the new stapled trust structure that was being implemented recently?
Yeah, so sustainability is at the core of everything we do. And this can be sustainability at the building level, but also in future-proofing our corporate structure. And we were fortunate to receive 99.8% overwhelming support by our unit holders to create this new business trust and staple it to the REIT. And this gives us a wider opportunity set for both investment and ensuring we have the most tax efficient framework from which to actually own our assets in, deliver higher value add opportunities for our new security holders.
Great. So the other question that I'd like to ask is, recently you have invested 50 million euro into the Stoneweg AiOnX data center. So may I know what's in it for SERT and why you do that?
Yeah, this is a really exciting initiative from us. We've been able to invest almost 7% into our sponsor's very significant data center development fund. And we've done that through the new business trust. Why is it exciting? These projects across 5 countries have already secured 1.5 gigawatts of power. And we all know that data centers are driven by electricity. And so with this size of opportunity, this is really a new engine growth for our REIT. And already we've seen the results because we delivered a 25 million euro fair market gain already on our initial investment. So investors are already 50% up on their investment in 6 days.
Yeah, I think that's great news because as you can see, being a REIT manager, you have to be very agile. That's why I can see the incorporation of the stapled business trust, and that will give you incremental benefits. At the same time, I think you are moving into sectors where investors are willing to pay a premium. So I think this is a very tactical, strategic move that you have been making.
Yeah, we have a good track record in developing our own assets as well. Recently, we just developed Italy's second most energy efficient office building, and on completion, it was already fully leased at rents higher than our initial feasibility, because European tenants are looking for energy efficient and high tenant amenity buildings. And our teams on the ground are able to deliver this, which therefore means an increase in NAV because we're making a development profit within the REIT, not within the sponsor and coming back into the REIT, but the REIT investors are benefiting from the capabilities of our team. So this will continue to drive NAV and longer term income, as well as obviously future proofing in a more environmentally regulated society that we're now in.
Oh, that's great, because I think as the investment climate is moving towards more ESG, I think future-proofing your buildings and your assets is very key, because you have to do it now, not later, because the cost will get more and more expensive later on down the road.
The other thing too is the banks are lending on green sustainability KPIs. So we've already received a lot of support from our banking syndicates around this strategy. It's very clear. Logistics, light industrial, predominantly in Western Europe, but with this added value through our AEI program, should put us in really good stead over the coming years.
That's great. Okay, what type of insights or thought leadership would you like to share with our audience and why?
In my long experience within the REIT sector, there are three factors that we really talk about within our team. The first is driving dividend and value growth for investors. We also have to have a very high level of governance, and I'm really thrilled that that's been recognised through the SGX community, having recently been voted in the top 5 of all Singapore listed companies for our governance. And the third aspect is transparency. We're a listed company and we need to help investors understand our portfolio and our strategy. And so that's something that we work very hard on. So earnings growth, governance and transparency overall makes a very sustainable investment proposition.
Yeah, this one I agree. One more thing is something that many investors have their minds. How have tariffs impacted your recent earnings?
Yeah, so look, with the recent US administration discussions and movements around the tariff story, clearly that's not good for decision making by corporates. And I've just come back from a couple of months in Europe, seeing our tenants, seeing the property markets, speaking with agents and our local teams on the ground. And that's a really important point, is actually being there with our teams and working with our tenants and understanding their space needs. We're only one part of their investment decision, but it's an important part on which buildings, which space they occupy. So in this uncertain time, clearly decision making is being stalled until there's more clarity around the overall impact. So at the moment, it actually helps our tenant retention. The second longer term benefit of not just the sort of the tariffs itself, but the overall geopolitical tension that has been created in the last 6 months really is galvanizing Europe together. And we can't emphasize that more or illustrate it more than through Germany's recent relaxing of their debt ceiling and their commitment to invest over €1 trillion in both their infrastructure and their military industrial sector. We're already seeing that in space take up in warehouses, that industries associated with the military are already taking up to 20% of European logistics space. So longer term, this will drive higher economic growth. But in the short term, yes, decision making is being stalled, and so that's having an overall dampener on the economy.
Okay, great, because what I see is that with more companies doing diversification away from these geopolitical tensions as well as tariffs, I think in the near term there will still be volatility in earnings, but in the long term I can see there's still growth in your company.
Eric, I'm going to disagree with you.
Is it? Good.
In COVID, when GDP collapsed, we only lost €500,000 of rent out of 150 million. We have over 1,000 leases. Our largest tenant only makes up 4% of our income. Our top 20 tenants make up just over 25%. So it's a very diversified and resilient portfolio. No one industry sector makes up more than 15% of our portfolio. Our largest country is less than 30% in the Netherlands, and that's a AAA rated country. So we have a barbell approach when we look at industry type, tenant diversification, and it's 100 assets. We're not relying on one single asset or one single sector of the market. So there's plenty of diversification within our REIT. So our NPI volatility, this is why I disagreed with you with respect, is our NPI just has been growing nicely. What we've been facing as an industry in the last 3 years has been the reversion from zero interest rates to a more normal interest rate environment. And that unfortunately has had a dampening effect on dividends. But in our result, we announced a couple of days ago, we've now reverted and recycled all of that low interest to now the more normal levels. So the impact over the last couple of years, we think is now based out. Thank you.
That's great sharing. So that now get the first-hand insights from you, I think we can share this with our audience so that they have a better clarity.
Thank you very much.
Thank you very much for this
Thank you,
interview.
Eric. Thank you.